Welcome everybody to the inaugural meeting of the Stanford Big Data Initiative in International Macro and Finance. I'm Matteo Maggiori. I'm an associate professor at Stanford. I'm one of the co-organizers. The other two organizers are also here with me. It's Brian Nyman from the University of Chicago and Jesse Schrager from Columbia University. And we're really, really pleased to hold the event this year. Unfortunately, this year we've had to do it virtual, but in future here we hope to be able to revert back to being in person. What is international macro? It's really an exciting field that is about the study of how households, governments, and firms interact in an open economy. So it's, these are topics that affect the livelihood of millions of people. They're things that we truly care about. And in these very brief opening remarks, I want to go over some of the major events and major things that are happening in the world out there that affect all our lives. And also in particular events or areas of studies where papers that are going to be covered in the initiative have really made major contributions in advancing our understanding. So I'll start with the idea of China that in a space of 20 years went from being a relatively small player shut off from interacting with the rest of the world to really a major macroeconomic player in both the goods market and the financial markets. Or you can think of like the Eurozone. I mean, the Euro has been one of the biggest political and economic experiments of the post-war period. And as economists, we care about things like price adjustment. How did price adjustment within Germany and Italy work out once we removed the nominal exchange rate flexibility? Or the sovereign debt crisis that all of us have gone through recently with sovereigns in Europe experiencing really tough financing conditions. Or the idea that capital in the union might have been misallocated rather than financial integration improving the efficiency of capital allocation, it might have gotten worse. Or you can think of, here in the US where most of us live at the moment, you can think of the US as a world banker, a country that provides a lot of safe assets to the rest of the world and takes these proceeds and goes on and to invest in world risky assets. A lot of the safe assets are denominated in dollar, and this has also contributed to big global imbalances. As you probably know, the US is a very large debtor vis-a-vis the rest of the world, and that was one of the important dynamics of the 2008 financial crisis. More recently, if I put the US and China together, we've been thinking about trade wars. There has been an escalation of tariffs between the US and China. It's unclear who pays the cost. Is it the Chinese firms? Is it the US importers or retailers, or does it get passed through to the US consumers? These are things that we deeply care about. Similarly, Brexit. I mean, it was a very big, unexpected event until a few days to the referendum. We didn't know that Leave was going to win. And there's been a big question of, was this good or bad for the British economy? Did the promises of the Leave campaign materialize and their benefits, or did investment get depressed? Very, very recently, something that we're still all going through, you can think of COVID. In the short run, we've seen very big sudden stops. Flows of capital that rush out of emerging markets, depriving them of financing in a time where they would like to do fiscal spending to confront the pandemic. But you can think also longer term, things like structural adjustment. Are global value chains going to change? Are some sectors going to get bigger or smaller? These are important questions. And why do we want to do this initiative? Well, at a very broad level, it's because large-scale empirical work has revolutionized many fields in the social sciences. You can think of applied micro, development, macro, and also international macro. There's a lot of exciting work going on that for example, covering the topics that I listed on the previous slide, that is using new data or new methods. On the other hand, for those of us that are working in the field, there is a realization that large-scale empirical work comes with a little bit of its own problems. And one that we're keenly aware of is increased barriers to entry for new researchers like you, for PhD students. They come in the form of, the data can be very expensive or very difficult to acquire. The computing that is necessary to handle the data can be very difficult to scale up to as a PhD student. The size of the research team has been expanding enormously, while the size of doctoral dissertations hasn't necessarily expanded that much. And the time to complete a project can be very different. So the initiative seeks to really do two very different things. One is a very traditional role of communicating to you where we see the frontier of the field, what is exciting, what people have been doing. That's a fairly standard role for a training camp. But there is a second component that is a little bit different. What we try to do is provide you with a starter kit of tools and data or know-how on how to handle this data. Things that essentially we as researchers had to figure out ourselves, And we would love somebody to have told us at the beginning, here's how you save time. And the idea is trying to bring you from somebody that would like to do research in the field very quickly to somebody that can actually start answering questions and doing research without necessarily spending a year gearing up for it. I would like to acknowledge that this is a long-term goal, and so we're building up to it, and we'll love your feedback. I also want to acknowledge a very generous support of the Sloan Foundation and Stanford GSB, who in future years will also allow this to be an event that we can hold in person and bring you all to Stanford. I mean, most of all, I really want to stress, at least from my perspective, this is a very exciting field. It's also a great time to do research in the field because a lot of this research is taking off right now. And as PhD students, you're always trying to look for the next big thing. What I'm going to do for the rest of the opening remarks is really touch on a few of these big topics and go over some of the papers that are going to be covered. Each of the authors in their own sections will do a much better job than I will, but I wanted to give you a common theme of why these new methods and new data are providing us different and better answers on these important topics. So I'll start with the euro. The euro, as I said, has been a huge political experiment and an economic experiment. It was predicated on the idea of real and financial integration. The idea that as we created the European Union and the Eurozone in particular, markets both for goods, for people in the labor market, and for financial assets will get more integrated, and this will have benefits. Recently, there's been a lot of skepticism in Europe, where a lot of the populist movement is seeing the euro as a source of all sorts of evils. And as economists, we'd like to ask, okay, what merit is there to this sentiment? What are the problems? What has worked out and what has not worked out? And one very important element has been price adjustment. We took out a nominal exchange rate flexibility. We actually went on the same actual currency, and we want to know how did that work out? How did financial integrations work out? Did the capital allocation across countries or across firms improve in efficiency with the integration of financial markets in Europe? And here I want to highlight two really brilliant papers. One is from Alberto Cavallo, Brian Nyman, who are both going to teach in the initiative, and their co-author Roberto Rigobon. And what I'm showing you here is the authors went out and collected data at the goods level for billions of prices around the world for identical goods. So you can think of collecting the price of an Apple laptop in Germany and the same Apple laptop being sold in Italy. Then what they're going to do is adjust for the nominal exchange rate, which in the case of Italy and Germany is 1, but in the case of Germany and the US will be the euro-dollar exchange rate. And they're going to build what they call the good level real exchange rate. That's what they're plotting here, and they're plotting the log of it. So a log value of 0 means that the two prices are identical. The low of one price holds. And one big pattern that emerges quickly from this figure is that if you look at Austria, France, Ireland, Italy, all the countries of the Eurozone, there's an immense mass at 0. The low of one price holds remarkably well. And this was one of the first studies that could show this so cleanly, having collected the data for identical goods across many countries. But then there's a second pattern that is quite interesting. If you look at countries that are just outside the Eurozone, Norway, Sweden, Denmark, and Denmark in particular as a currency peg, a very stable currency peg with the euro, you find a lot more price dispersion. All of a sudden, you observe large differences in prices for identical goods, let alone if you compare to the US, an economy that is farther away. This was one of the first papers that allowed us to conclude that there is something going on with price adjustment, with relative prices across countries that had to do with the currency itself. It's not even that you have a flexible exchange rate. Denmark doesn't with the euro. It's on a peg. And yet you find a very different amount of price dispersion. Of course, that can come with its own problems. You can think that if in Italy, prices of goods are set too high for the local demand compared to Germany, then Italy might suffer a recession. We're not having that traditional adjustment of the Italian currency depreciating compared to the German currency. The second paper I want to highlight is again a great paper by Gita Gopinet, Sebnem Kalemiuk-Skan. Sebnem will teach in the initiative, Lucas Karabarbunis and Carolina Villegas Sanchez, where they looked at the idea of how has efficiency of capital allocation evolved in Europe over the period going from 1999 to present. And what they made use of is a concept pioneered by Pete Clino and his co-authors called the marginal revenue product of capital. Pete will teach in an initiative and tell you much more about this. But at a very first order level, you want to think of it as, I have two firms and they have different amount of capital, and in a neoclassical benchmark, they should really have the same marginal product of capital. If they didn't, the firm that had lower capital and higher marginal product of capital should experience a capital transfer from a firm that has more capital and a lower marginal product of capital. So one very simple measure of misallocation in the neoclassical sense is measuring the cross-sectional dispersion across firms in a point in time of the marginal revenue product of capital. And that's exactly what the authors are plotting here. The black line is this cross-sectional measure repeated over years after the introduction of the euro. They normalize it at 1 in the first year. And you can see in both graphs, the only difference here is the left-hand side has firms that stay throughout the sample, the right-hand side has any firm at any point in time, so it's unbalanced. But in both cases, you can see a steady increase in the dispersion of the marginal product of capital. And when Sebna will teach this paper later, she'll tell you about how to interpret this in terms of, this is for, by the way, it's for Spain, but the pattern holds more generally for the periphery in Europe. And she will tell you all about how this increase in the dispersion of the marginal product of capital is a sign of financial integration in Europe, actually leading to more capital misallocation and not less, and why. But these are pretty fundamental questions for how we think of the benefits of the euro and the eurozone. I'm going to switch gears slightly, but stay with the theme of Euroscepticism and go to Brexit. The Brexit referendum, I'm sure that you all remember it. Until a few days before, we didn't think the Leave was going to succeed. And when the shock happened, it's a typical example of what economists call an uncertainty shock. Immediately after the vote, it became clear that there wasn't a plan of how to handle the exit from the EU, that we were going to face a very protracted and long negotiation. And there is a question of what did uncertainty do to the UK economy? In particular, did the promise of the levers, all the benefits that they promised, materialize? Or did uncertainty depress investment in the UK or investments of foreign firms in the UK? And here I'm going to highlight a series of papers by Tarek Hassan and Nick Bloom that are using innovative techniques from natural language processing to actually create the data that measures uncertainty. How do we even go about quantifying an uncertainty shock? And I'm going to illustrate it by looking at a paper by Tarek Hassan and his co-authors. Tarek will teach this paper in the initiative in the next few days. They look specifically at Brexit. And so the top panel looks at Brexit risk. How do they define it? They're essentially reading transcripts of conference calls between publicly listed firms, so the CFO, CEO level, and their investors. And they're looking for the association of Brexit with the association of words that have to do with risk or uncertainty. They're counting them, they're weighting them in a particular manner to create an index. And the index that comes out, it's up here for non-UK firms and UK firms. And in both cases, you see that just before the referendum, there was almost no Brexit uncertainty. Then just next to the referendum here is this vertical black line. There's a little bit of a pickup, particularly for UK firms in uncertainty. But really the big uncertainty shock comes immediately after. The Leave vote prevails, and there's this huge spike in uncertainty where all of a sudden all of the firms are telling their investors, we're uncertain about the prospects of the UK, we're uncertain about passporting of financial services or the trade agreements. And then you can see that it ebbs a little bit, it comes down. And then towards the end of the sample, 2018 and 2019, it picks up again. And the authors in their paper explain that this mimics the ups and downs in the negotiations with the EU about the exit. That towards the end of 2018, it became clear that the exit was going to be quite complicated and they might not reach an agreement, and that caused more uncertainty. Of course, what the authors also do is they look at the first moment. There's a difference between uncertainty and do I expect in a mean sense good or bad outcomes. And they create a measure of sentiment to look at the first moment. And you can see a similar pattern. Before the referendum, there's a lot of sort of neutrality. Immediately after the referendum occurs, there's a big drop in sentiment. Sentiment becomes quite negative about the outcomes for the firms, both for the non-UK and the UK firms. Then things seems to get better, but towards the end of the sample, as it becomes clearer and clearer that the deal is going to be a hard one, sentiment comes back down. And when Tarek teaches you the paper, it'll show you how they bring this kind of very innovative data to bear on the real outcomes of the firms. Are the firms reacting to this uncertainty by investing less, by hiring less? Which firms in which sectors? So you get a much more nuanced picture of how the economy might have reacted at the firm level to a shock like this. Let me switch gears and talk a little bit about China. I want to cover China, the US, and then the trade war. I mentioned at the beginning, in the last 20 years, China has been one of the biggest players in international macro because we saw it going from being largely absent from the international context to being really a big force in world financial markets. Currently, China is the third largest creditor in the world. It's after Japan and Germany. It has a $2 trillion net foreign asset position. What is that one? Net foreign assets are what Chinese residents own abroad versus what the rest of the world owns in China. So it's the net creditor position of China vis-a-vis of the rest of the world. But I want to highlight also some positions to give you a sense of the order of magnitude. China owns $1.1 trillion worth of US treasuries. That's a large position that has attracted a lot of attention from both political commentators, but also economists, given the tensions with China. A little bit less well known is that Chinese companies listed abroad are also extremely valuable. There's currently about $1.8 trillion worth of Chinese equity listed on world stock markets. Foreign companies are also exposed to China in ways that don't have to do with just the stock market. They're exposed to China for both inputs, they're importing intermediate inputs from China, and for sales. And I'll show you some of that data. So this makes China a really interesting force to study in international macro. Here I'm going to highlight some of my own work with Brent Nyman and Jesse Schrager, the co-organizers of the initiative, and a wonderful PhD student at Harvard, Antonio Coppola. What did we look at? We wanted to focus on this idea that China is a very large creditor to the rest of the world. And yet there are all these Chinese companies that are listed abroad and they're actually resident, they're domiciled in tax havens. They're mostly domiciled in the Cayman Islands. On the right, I'm going to give you a very brief overview of a complicated corporate structure that Chinese companies use to access world financial markets. So if you think of Alibaba, for example, the listed company that all of us can buy on the New York Stock Exchange is actually not the operating company in China. It's an affiliate of that company that is registered in the Cayman Islands. And that affiliate itself will control what you and I think of Alibaba as Alibaba, the operating company in China, through a fairly sophisticated chain of contracts that have the purpose of avoiding the capital restriction in China that foreign investors cannot own equity in strategically important sectors. Now, what does that matter for us as economists? Is because it turns out, and we'll go into more details later, that through this structure, what happens is that the full equity value of the listed company does not get reflected into the official liabilities of China. So the black line, the black dotted line that you see in this graph is what I mentioned before, is the net foreign assets of China, the 2 trillion. Here they're expressed as a percentage of Chinese GDP. And this is a big global imbalance that has attracted a lot of policy attention. What the red line instead is our own estimate of how much China really lends in net to the rest of the world once you correct for the idea that there are all these big Chinese companies that are raising capital, so they're increasing liabilities of China in the Cayman Islands. And you can see that the correction is quite big. China is only 50% as big of an official creditor to the rest of the world as the statistics, the public statistics say it is. So it changes our understanding of one of the big imbalances around the world. If you go deeper and you ask, well, how exposed are developed market investors, so investors from the US, from Canada, from the EMU, from Great Britain to China in the equity market? If you look at the official data, the data that you can download from, for example, the US Treasury, it's these red little bars here. It seems very low. It says that only 2% of all foreign equity investments of the US is in China. But if you correct, as we do in our work, for the idea that a lot of the investment goes into tax havens first, and then ultimately makes its way to China, all of a sudden you get a vastly different picture. You get that 10% of all foreign investment of the US in China is in China. So you can really alter the basic understanding of these patterns. To the right, it's a very similar graph, but we ask a slightly different question. We think about, well, maybe the exposure to China isn't just whether the company is Chinese or not, but it's through the sales of the company. So I might be buying an American or a European company, but if they do 70% of the worldwide sales in China, that gives me a big exposure to Chinese demand shocks. And so these graphs are redoing the same calculation, but using the fractional sales that companies make in China. And you can see that now you reach an even bigger conclusion. The US exposure to China via the equity market is 15%, which of course gives you a different sense of the wealth loss and the negative wealth effect that might come to the US consumers or to US households if we get into some further tension with China. I want to focus a little bit more on the US. I mentioned the US as the center of the world financial markets. We mentioned treasuries briefly as being the issuer of ultimate safe assets, and the dollar really being used as a mean of or a vehicle currency in both good markets and asset markets, irrespective of whether the US is involved in the transaction. You can think of a European lender to a Brazilian firm lending in dollars. The US is not involved at all, but the dollar is involved, and that's extremely common, as I will show you. The US is also a very large provider of global liquidity. It's not just the US banks. During the COVID crisis, you've read in the newspapers, the US has extended very large swap lines, dollar liquidity to the rest of the world. And there have been some drastic changes, which I will highlight on the next slide, since 2008. So one of the changes I want to focus on, it's here on the panel A. This is from a wonderful paper by Wengxin Du, Tepper, and Adrian Verdon, and both Wengxin and Adrian will teach in the initiative. They focus on an arbitrage condition called the covered interest rate parity condition that essentially prevents you from making money from switching the borrowing and the lending between two currencies while hedging the FX risk. And this condition held remarkably well for 30 years, from the 1970s to today, until 2008. And after the financial crisis, you can see on this graph, these arbitrage profits get very big. So right now, there are hundreds of basis points that you could make arbitraging the dollar-yen market. But the beauty of these kind of papers that are using very rich data and new techniques is that you don't have to stop there. The authors do a fantastic job establishing that really this is an arbitrage, and why is it not being closed, and it was actually being closed down by international capital before the crisis. They look here on panel B at what are called quarter hands phenomena. So the banks that are major players in trying to shut down this arbitrage have the problem that each quarter, the regulators take a snapshot of their balance sheet and they apply capital charges for macroprudential regulation based on that snapshot. Of course, that makes it very expensive to hold these trades over the quarter end. And what the authors show us is that the spike in the level of this arbitrage, the arbitrage opportunity widens precisely at the quarter end, where the banks don't have enough capital or enough willingness to hold the trade. So they make it very, very precise that this is an arbitrage, and what is causing it is a shortage of capital in the big international financial institutions. At the bottom, I plot two graphs from my own work with Brian Nyman and Jesse Schrager, where we look at the phenomenon I mentioned in the previous slide, the international role of the dollar. On the left-hand side, I'm plotting for you the total amount of bonds that are held cross-border that are denominated in dollar or euros. So you can think of a European investor holds a bond from a Brazilian firm, and we're going to count whether it's in dollars or it's in euros. And you see two phenomena. One that you probably know, that the dollar is a big deal. It's 40% of all these cross-border positions are in dollars. The euro also used to be quite big, but somewhere around the financial crisis, there's a big shift in these international portfolios. The dollar share goes from 40 to over 60. The euro share goes to around 35 to being below 20. Now, the beauty of rich data sets where you know exactly who owns what is that you don't have to stop at these aggregate patterns. You can go much deeper, which is what we do on the right-hand side, and start stripping out things like the currency effect, price effects, sectoral effects, some countries are coming in later in the data set, or some sectors are growing or shrinking, to really convince yourself by cleaning the data some more that the pattern, the shift, it really does have to do with the currency of denomination of the assets and not with some other possible confounding effect. So these are common elements of the research that the initiative will try to cover. If I put the US and China together, I get to one of my last slides, which has to do with the recent trade war. And this is really a fantastic paper by Alberto Cavallo, Gita Gopinath, Brent Nyman, and Jenny Tang, and Alberto and Brent will teach it, where they're asking who pays for these tariffs. So they're collecting very detailed micro data on the price of goods at the US import level at the border. So the price the US importers pay, but also the price that the US consumer faces in the retail market in the US. So if you look at the graph on the left, they're gonna split the goods into various categories. First, goods that are unaffected by the US tariffs. Second, goods that are affected by the US tariffs, but they're not affected because they're not being imported to China. So they're goods that could have been taxed if they were coming from China, but they didn't come from China. And third, all the goods that did actually incur the tariffs, and also the point in time in which the tariffs were introduced. They're checking the US import price, including the tariff. And what they're concluding is US importers, or sorry, Chinese exporters are keeping the dollar price constant. So the US importer is paying dollar price plus tariff. And that's exactly these jumps in the price that you see. On the other end, when they go to the right-hand side and they check the price of these goods that ultimately the US consumers faces in the retail market, they don't find such a strong pattern. There's some evidence, but it's much more mixed. And so what they conclude is that the margin that is really adjusted, where the tariffs have been absorbed, is the US retail margin. It's the difference between prices at the border and prices that the consumer face. That's a retail markup, and that's really what has absorbed the tariffs. So it gives you a very different picture from perhaps what has been pushed out there of the tariffs are going to be paid by the Chinese exporters. Finally, let me talk about COVID. I mean, this is going to drive the research of the next 10 years. I remember when I was a PhD student in 2007 and 8, some of my professors told me the financial crisis will drive research for the next 10 years. Let me give you the same message. COVID will drive research for the next 10 years. There's so many important issues, from structural adjustment of the world economy, global value chains, capital reallocation. Capital flew out of emerging markets, is now dribbling back in. How did that work out? Who got affected? The fiscal union and the Eurozone. I mean, finally, COVID seems to have given an impetus or the political willingness to generate large fiscal transfers between the core of the unions, Germany, and the periphery, Italy, Spain. There are mounting debt levels, and we need to start asking questions about whether this is going to end up with a wave of sovereign defaults. And what about US debt levels? They're skyrocketing. Should we worry, or do we have lots of fiscal space? The role of the dollar, if anything, it seems to have been strengthened by the current crisis. There was a lot of demand for dollars all around the world. These are all issues that are going to occupy the research agenda for a while. The one thing I want to briefly highlight is a paper by Nick Bloom, who will teach it in his session, where he looks at the effect of uncertainty on the real economy. So on the left-hand side, I plotted their index of US economic policy uncertainty. And again, very much like the Brexit index I showed you before, this is built through a natural language processing of news, in this case, that are out there, trying to look at news that relate to policy and relate to uncertainty. And you can see the COVID shock up here being absolutely enormous compared to anything that they register in the US starting in the mid-80s. Further, they bring this shock through a structural macro model to try to ask, okay, what of the falling GDP that we're experiencing, what part is due to the impact of the uncertainty shock alone, and what part is due to the impact of both the uncertainty shock and the first moment shock? I mean, we clearly got a first moment negative shock through COVID, and they're going to try to decompose the importance of the two. This is just one example of many papers that I think we're seeing already, and I think we're going to see a lot more in the next few years trying to deal with the COVID crisis. I'm going to conclude briefly, but I wanted to give you a sense of the excitement about the field and how these newly available data and newly available methods are changing the field. And they're really allowing us to answer existing questions in a different way, or in many cases to pose questions that before we could just not analyze. There wasn't enough data or enough power to analyze it. And these are, to my knowledge and to my understanding, big questions that affect welfare all around the world. And I think there isn't enough research being carried out, but that also creates a huge opportunity for all of you, because you want to be in a place where there are great questions and not a lot of research being done, because the marginal product of capital is high, and you should flow to those questions. I'm going to stop it here. I hope you enjoyed the initiative.